This is joint work with my brilliant set of co-authors, with Paul, who I think is going to be online. And I also just want to highlight, Paul's recently had a baby, so please just like flood him with congratulatory messages on Slack. He'll be in between diaper changing during this presentation. And just a couple of boring caveats. Paul, Stefan and myself used to work for the UK financial regulator, the Financial Conduct Authority. That's where this work was carried out. And it doesn't reflect their views or the views of Paul or Stefan's current employers. Okay, boring stuff out of the way, let's get cracking. So the title of this paper is The Semblance of Success in Nudging Consumers to Pay Down Their Credit Card Debt. Now the thing with that title is it gives a bit of the game away about what we're actually doing and what the result was. So I'm not going to do the normal summary of like, this is the results. I'm going to try and keep you entertained and on edge and like away from TikTok for the next 30 minutes and try to tease out the story as we go. But the main thing is we were doing an ex-ante test of a potential regulation the UK regulator was thinking about implementing. And it was a nudge and it was designed to reduce persistent credit card debt. Now, why are you potentially interested in credit card debt if you're the financial regulator? Well, in the UK, its credit card market is very much like the US. There's a lot of it and it's expensive. So if you aggregate up the two countries, it's about 1 trillion outstanding stock of credit card debt and interest rates are around 20%. And there's also more generally a variety of really interesting puzzles in credit card repayment behavior and things that you see in the market that are kind of often hard to rationalize. So there's some great reviews. There's a new gel paper by Gomez that's really worth reading if you're interested. But broadly, yeah, the thing I want you to remember is there's a lot of debt and it's expensive. And the UK market that I'm going to show you works very similarly to the US. So just a bit of history. So if we go back to 1999 to 2005, you'd had in both the US and the UK, this rapid rise in credit card debt. Actually, the UK, which is the top line, the maroon line, rose quicker. It actually doubled between 1999 and 2005. Then you had the financial crisis. What happened in the US was you had this very sharp deleveraging with a load of defaults, less new lending, more repayments. You had some deleveraging in the UK, but broadly speaking, outstanding credit card debt was kind of flat for a few years. So then you get to 2014, and if you're in the UK, you're like, huh, there's this, what was already a fairly large stock of credit card debt before the crisis that's still kind of sticking around. So you can try to, that kind of gives you a bit of an impression where the regulators were coming from. And then obviously after 2014, you'd again seen fairly steady rises in both countries until about last week or the 2 weeks before. And this is a paper using nudges, and nudges aren't any more of this kind of weird novelty thing that some academics do. They're broad-based in regulation and governments across the world. This is from the OECD. There's over 200 units using behavioral insights. Just to be clear, they don't just do nudges, but nudges are definitely the flagship thing that they do. I now want to go into a bit of institutional detail about how credit cards work in the UK. The good news is that they basically work the same way as in the US. So this is the time if you're like a super expert on US credit cards, make a quick cup of tea, listen in the background, and I'll just like whip through it. So with credit cards, unlike your mortgage, which will have like a fixed amortization schedule, credit cards have this minimum payment feature. And the calculation is shown there. The key thing about it is it goes down, it's a function of your balance. So when your credit card balance goes down, your minimum payment that you're required to pay also decreases. So it's kind of getting harder and harder to repay your debt in full if you're just following that rule. And just to show you what it means in a kind of very simple stylized example, let's say you had £1,000 in credit card debt at typical APR and you only paid the minimum each month, it would actually take you 18 years to repay your debt in full. And the interest costs would be more than the amount that you borrowed. Now at this point, I just want to be really clear. I'm not saying that minimum payments are a bad thing. It's definitely a good feature to have something like this where you can occasionally go down and deal with liquidity shocks to income or expenditure. You only get this kind of thing as if you're repeatedly only paying the minimum. And that's the kind of thing that we're interested in. And in this stylized example, the minimum payment would have started at around £25 in month 1, and then as the balance dropped, it would have gone down to £5. If you are able to keep paying that £25 each month rather than declining with balance, you then decrease your credit card debt quite significantly. So you would actually repay in 5 years, more than half the interest costs. Furthermore, above that, if you're able to pay a little bit more, say £50, you get into quite aggressive amortization schedules. And again, if you were able to pay this £25 or £50, even if you dipped into minimum payments occasionally, you would still be repaying your debt very quickly. It's only if you're repeatedly paying the minimum where these kind of scary things happen. Now, when we look in UK data, who are these people who are repeatedly only paying the minimum on their credit card? They often have these things called automatic minimum payments. This is a type of what's called auto pay in the US, direct debit in the UK. They're typically set up when you take out a new account, like a new credit card, and you'll go to your credit card provider and say, I want to set up an automatic payment, and it will automatically take an amount for the minimum from your checking account every month, assuming you have enough money in your account. Now, seems like a really good thing, right? We all live busy lives. Something to make our lives a bit easier is really helpful. It provides near perfect insurance against forgetting to pay. It ensures you're always paying the minimum as long as you've got enough money in your checking account, basically. And you want to try and pay the minimum, because if you don't, these bad things happen, like you have a late fee, you're going to get some interest costs incurring, going to have a credit score impact as well. So you want to try and avoid that. But you can also think about this automatic minimum payments as kind of a bad thing. You're now kind of potentially more inattentive to your debt. You no longer have to think every month, I've got this credit card payment to make. It's already done. You can spend your life having fun and doing other stuff. And so what happens is you can think that if you don't have that event every month to think about your credit card debt, interest cost is going to be kind of non-saliently accruing. And the contrast we use here is like a late fee is a very salient event. Your bank rings you up, they tell you, they send you letters, they're like, pay it, pay it, pay it. No one does that with interest costs. So, and I've shown you, if you're just only paying the minimum, it's not repaying down your debt much. So if you really want to repay your debt, there's some effort costs, whether it's physical of phoning up or logging into your online banking, or psychological to actually go in and make a payment that's going to actually make some substantive difference to your debt. Okay, that's the boring institutional stuff out of the way. So anyone who's making a cup of tea, you're now back and we can get into the actual experiment. What did we do? So we ran this field experiment in normal way, RCT, pre-registered, everything under the sun. And I'm going to show you results from a large UK lender that covers the breadth of lending. This covers high credit risk, low credit risk, people, breadth of credit limits. It's really pretty comprehensive. And basically every one of their new credit cards that were issued over this time period were captured, and I'll show you how we define captured in the next slide. But I also want to flag, we tried to run this with a second lender, and we did run it with a second lender. But the initial effects were so large that after a week of field work, they stopped the trial. Now, I will show you those initial effects, that's why they were scared off. And in the paper, we do report like the longer term outcomes, but obviously there's two problems there. One, the trial is just woefully underprepared for that lender, so you don't trust it, you can't say anything about it. But more importantly, that if you stop a trial based on an outcome, that's p-hacking, so you just can't really trust the results. But it's important just to kind of be clear about that, and it's a useful anecdote on the practical difficulties of regulation. Okay, so how do we capture people in the trial? So as I said, everyone who goes to this lender and has applied for a new card, if they're then asked, would you like to set up an automatic payment? And it's an opt-in system, so they don't have to do it. They don't even have to say no. It's just if they say yes, that's something I'd like. At that stage, they're now captured as being potentially in our trial. And it doesn't matter if they don't do that on the first day at card opening, as long as they do it within the first 30 days, they're captured as, and then randomized at that point to the control or the treatment group. So if you do say, yes, I would like to set up an automatic payment, in the control group, this is what you're presented with, and this is what you normally see. You get 3 automatic payment options. So on the left, and the good thing about presenting online, my left is your left for a change. The minimum is the option that I talked through. The middle option is to repay your debt in full, what we're going to call an automatic full payment option. That's an option that we're less interested in. Those people don't incur any interest. They're just using credit cards for points and intra-month smoothing. But then you have this third option, an automatic fixed payment option, is what we're going to call it, which is a free text box where you can put in any amount of your choosing. Now, how does this third option work? Well, it functions a bit like a ratchet. So it was always going to take the higher of the amount you put in that box or the minimum payment. So it always ensures that you'll at least cover your minimum and maybe pay a bit more. And just to be really clear, say you put £50 in that box and your minimum payment was £25 that month, it would take £50. Whereas say you had a bit more fun, spent a bit more last month, and your minimum payment was higher and £75, then £75 would be taken from your account. Now, one thing to flag is if you put £5 in that box, it's exactly the same as doing an automatic minimum payment. It just isn't called minimum. It's just, but mathematically, it produces exactly the same schedule. Now, why is that important? Because our treatment, we remove the explicit automatic minimum payment option. So this is a very simple treatment, but it's a nudge because they can do exactly the same thing as an automatic minimum payment option by putting £5 in that white box. And that's the only change in the treatment. So just to talk through the mechanism that we're designing this experiment to work through, the intention was to increase automatic fixed payment enrollment instead of automatic minimum payment enrollment. That transfer through into increased automatic payments, result in people being likely to pay more than the minimum, and change the things that we actually care about, people's debt and interest costs. And I just want to be really clear, we don't care about automatic fixed payment enrollment per se. As I said, it may be good or it may be bad if people enroll in automatic fixed payments or automatic payments more generally. We're just using that as a lever, as a way to try and easily on day one get people into a kind of potentially better cycle of repaying their credit card debt in a very easy, low cost way, low effort cost way, sorry. Results. So we see pretty substantial differences in enrollment to these automatic payment options. So I think it's salmon bar is the automatic fixed payment option. And you see that increases by 21 percentage points. So a 72% increase. And you'll see there's a decrease in automatic minimum payments. Why does that not go to 0? Because in both the control and the treatment, a customer can phone up and ask for an automatic minimum payment in the normal way. We're just changing the online environment, which is where most things happen. And you're also seeing a slight increase in automatic full payment enrollment and an increase in dropout of any type of automatic payments, the black bar at the bottom. And I mentioned the second lender that dropped out. This is why they dropped out. The effects were even larger. So for them, there was a 40 percentage point increase in automatic fixed payment enrollment. And we're seeing similar effects for the other automatic payment types, similar direction of effects to the main lender. Now going back to the main lender, let's look at the effect on paying only the minimum month by month, seen with having a persistent decrease in the likelihood of paying only the minimum. So by the 7th statement, that is 7 percentage points lower in the treatment than the control, so that's 24%. Now, if I stopped here, you'd probably say the trial's a success, but as I said, the problem with the paper is the title gives the game away. And why is that? Because we see this. We find no change in debt. Similarly, if we look at our kind of array of pre-registered outcomes, we're estimating like 0 effects across these. The ones with the stars are the effects of only paying the minimum. Well, I'm sure this will come up more in the discussion, so I can come back to it. Why no debt reduction? I've just shown you that there was this large change in enrollment. I've just shown you that people are paying more, are less likely to only pay the minimum, and that's persistently over time. And yet there's no debt. That's kind of a puzzle. Now, we're trying to piece this together, and I think we've got 3 offsetting consumer responses. And here's my nudge that hopefully does work. Keep slacking if you're not already. I'm not looking at it, but hopefully this is a reminder. So we find 3 offsetting consumer responses. First one is automatic payments bind. So yes, we saw this large increase in automatic fixed payment enrollment, but the effects on choosing a fixed payment that wasn't binding at the minimum by the 7th cycle is actually about half as large. So a lot of those payments are just being selected what we think about as being potentially too low to make an impact. But still, you would think that would translate through into some effect on debt. It doesn't. Why else? Well, there's also some dropout. So I showed you this black bar increased initially. So more people are dropping out of making any choice or enrolling in any type of automatic payment at the start. And that continues over time. The dropout actually declines over time because more people in the treatment forget to make a payment. And one of the things you do when you forget to make a payment is you set up an automatic payment to prevent you from doing that again. So we see more people in the treatment forgetting to make a payment. One of the good things is though, we don't see that results in them going into some kind of debt spiral. We see no effects on missing 2 or 3 statements. It generally seems though they just forgot as a result of not being less likely to have an automatic payment set up. But still there's a bunch of people, right, who we've shown you have automatic fixed payments set up for more than the minimum. Like surely those people are like generating something that's going to kind of generate some debt reduction. But the answer is no, because what those people do is, yes, they increase their automatic payments slightly, but they decrease their manual payments in response. So just to be clear, what I'm showing you here, this is an endogenous cut of data. So we're just looking at people who have automatic payments set up. So this one's definitely like not a causal estimate, but it's indicative of showing that actually there's this group of people who are shifting the type of payments they make, whether it's automatic or manual, but not the amount. And that nets off when you look at total payments. Now, these manual payments are kind of interesting to look at. They're manual payments among those people with automatic payments set up. They're infrequent, so less than 1 in 10 are making them any particular month. But when you look at them in terms of debt reduction, they really matter. So they account for 40% of the total value of payments made by this group over 7 cycles. And just to give you a sense of magnitude, yeah, your typical automatic payment is £100, whereas your typical manual payment for those people with automatic payments is £400. So these seem to really matter. Okay, so that's why we call this paper the semblance of success. We've shown you these large proximate effect of the nudge, increasing enrollment and decreasing in likelihood of paying only the minimum. And yet we see no kind of distal effects on debt due to these offsetting consumer responses. Now we think about the implications of this. I think there's kind of 3 takeaways on kind of regulation, nudges, and credit cards. It's good if you write a paper on regulation, nudges, and credit cards, you have a takeaway on 1 of each. And so that's what we tried to do. I think the first one is regulation is hard. I say this as a former regulator. We really thought this would work, right? If you think about the kind of checklist you want to do to try and get RCT to work, I think we did the checklist, right? We did the lit review, we did data analysis on all the credit card data in the UK you could possibly want, did qualitative testing, we got feedback from regulators. We went out to every consumer organization and every lender in the market and chatted to them and like, what do you think about this? Do you think this will work? And they're like, yes, we think this will work. And it didn't. Now, sometimes evidence-based policy is not to make policy, and that's what the FCA did. Obviously, look, I used to work for them, but I genuinely think that the FCA deserves a lot of respect here for testing a policy that they were thinking about implementing. That is for those of you who've worked with policy-making organizations, that's a hard thing for any regulator to do. So I think, yes, this paper is called Semblance of Success, but in terms of regulation and science more generally, hopefully we can agree it's called a success. Second, this paper really kind of contributes to a growing literature on how to think about nudges and really like the role of offsetting effects. And here I'm shamelessly stealing from my co-author David Laibson's AEAFA lecture on this topic. So basically what we care about is these longer term distal outcomes to inform welfare. But historically, often nudges and potentially other interventions are often measured based on these proximate choices that are easier to measure and quicker to find them, like more short-term outcomes. And that's fine if you think the proximate effects are going to translate into the longer term, harder to measure outcomes. But you seem to see all these offsetting effects and a bunch of reasons why those proximate effects get worn down over time. And so what may be a small effect actually goes to a zero effect. And there's a couple of great meta studies on the effectiveness of nudges, and they're really showing that, yes, there are a couple of flagship studies of nudges that are great, but really when you look at the breadth of them, a lot of them have no impact or very small impacts. Now, that's not to say nudges are a bad thing. They're hugely cost effective. So even like if they have a small effect, they can be a very good tool for policymakers to use. And so there's this discussion with Lowenstein and Chater, which is kind of reconsidering the role of nudges and whether basically nudges have crowded out a role for hard paternalism interventions. Again, I'm sure that will come up at some point in the discussion. Thirdly, this is a paper about credit cards. I should try to say something about credit cards and consumer behavior. Thankfully, that's not too hard. I think one thing that surprised us is we were really had in mind that these automatic payments were going to be good to nudge because we thought people were going to be pretty inert, right? When we looked at the data historically, you often set up your automatic payments on day one and don't really change them. And if you didn't set it up on day one, you only set it up at a later date if you missed a payment. So it's not like this thing that you're like regularly changing or checking in on. But we've seen here that it doesn't seem that people are as inert as and nudgeable in this space as we thought. So there's something else binding, whether that's economic or psychological. We've got some other papers that seem to imply that it seems hard to believe that it's just liquidity constraints going on. So maybe, but I think obviously the liquidity constraints are part of the story, but to explain why no one's on average doing things, that's not clear. And these manual payments among people with automatic payments seem really important to consider as well. And we're like starting to think about how to think about these manual payments among the people with automatic payments. I think there's two the theoretical literature can point of two kind of stories that you could tell. So firstly, you can maybe think about a kind of rational inattention type story that maybe people are taking out a new credit card, and at that point, they intend to make a manual payment at a later date. Now, if you're doing that, you really don't care about what your automatic payment is set up to do. And so then you're just going to kind of adjust your manual payment later on. Your initial choice is kind of arbitrary. I think like when you see the manual payments, these infrequent lumpy manual payments, this automate a lot of you probably thinking adjustment costs, SS models of the type we see in mortgage markets. And this seems like an avenue that maybe exploring in separate work. I haven't seen a paper on SS models in credit card markets, but that's something that we're considering doing separately as a follow-on paper. But the idea would basically be that your initial choice is affected by the minimum payment acting as a focal point. So there is some kind of behavioral component to why people are changing that initial choice. But then there's some cost that means you're not going to kind of refine your automatic payment or your manual payment month by month. You're just going to deal with it by adjusting your manual payment at some point irregularly in the future. Yeah, great to hear kind of other thoughts on other stories. This week, yeah, really valuable discussion. And then I think at the moment you can't present something without mentioning the C word. So I wanted to kind of go full circle and give it as though I've actually kind of gone nowhere in this presentation. We had this large stock of credit card debt in the UK and the US. And this was an issue that regulators were concerned about, whether consumers could repay. Now we've had a big shock. What's going to happen to that credit card debt? We've seen over the last week, it started to drop, but that's very early days. So I think there's going to be a real role for academics and regulators thinking about what to do about whether there's ex post measures or ex ante measures to try to potentially avoid people getting into really bad problems or deal with them as they do. Okay, thanks, that's me. Hope you're able to actually hear me and see me.